This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. My guest today probably doesn't need much of an introduction in the world of finance and investing. Howard Marks. He's an American investor and writer, author. He got his start early at Citibank, then joined TCW, led the high yield debt group. In 1995, he left TCW, co-founded Oaktree Capital Management. In the 2017 Forbes rankings of the wealthiest Americans, Howard was listed as number 374. And I give him all the props because that means a net worth of $1.9 billion. Nice job. Big round of applause. We can all take that as inspiration. One of the cool things that Howard also does, he has these Oaktree memos. And he has been writing these for a long time. You must go find them online. Just go search for Oaktree memos, the PDFs, some great research in there. Really a fantastic behavioral aspect that Howard outlines in his memos. Now today, primarily, our conversation is about his newest book, Mastering the Market Cycle, Getting the Odds on Your Side. I take Howard through the book on a wide-ranging tour, plus going back into his early history, so again, we can all be inspired. Now I must share something quite funny that happened. My very first question to Howard Marks, perhaps one of the most significant investors that I've had on this show, and you will hear this in a few seconds. My very first question to Howard, you can hear the phone ringing in my background. Yes, my lovely girlfriend decided to call at the exact wrong time. Now my podcast engineer, he said, Mike, you should re-record that. It sounds bad. But I listened to it and I said to myself, I'm comfortable enough with my podcast interviewing legacy so far. And I'm going to leave that phone ring in there. And it's going to imprint on my brain forever that my girlfriend was calling on my very first question to Howard Marks. I just kind of love that. Without further delay, without further crazy Mike Coveil story, let me jump right into my guest today, Howard Marks. So I was thinking, the next Howard Marks, he won't get to the same kind of success as the first Howard Marks, but there might be some rhyme to it. And the reason I want to go there is I want to take you back in time before we get into our main part of our conversation today, talking about cycles. I really want you to lay some foundation of your early career. I've seen you tell this great story where you go ahead and you outline your boss in 1982 telling you something about high yield bonds. And I thought that was the most fascinating story, and to go investigate this guy named Milken.
Well, it was actually in August 78, so we just passed the 40th anniversary. I had been an equity analyst and then the director of research at Citibank for the prior 10 years. It was time to find a new thing, and I was interested in moving into money management. The chief investment officer asked me to start a convertible bond fund. I switched to the bond department. I set about doing that. I was having a great time picking securities. And in August of 1978, the head of the bond department called me and said, look, there's a guy named Milken or something out in California. He deals in something called high-yield bonds. A client has asked for a high-yield bond account. Can you figure out what that is? Nobody had an idea. Nobody knew about these things. I had never heard of them. Fortunately, that was the beginning of the high-yield bond world. Prior to 1977 or 78, it was not possible to issue a bond with a credit rating below BBB. And then, in part, Michael Milken, in part others, created an innovation to the effect that you could issue bonds rated double B, single B, even triple C, if they offered enough interest to compensate for the risk. So that was the very beginning of the high yield bond world, as I say. A great time to get that phone call. There's nothing like being early.
Can I ask some early understandings that as you started to pick it apart and understand the high yield space, how quickly did you know that your life had changed? Now, of course, there was many people in milking and raising capital for so many entrepreneurs across America. How quickly did you know your life had changed and you were going to really get started down the high yield path?
Personally, my life had changed because I loved money management so much more than running a research department, which was an administrative and bureaucratic task involving 75 people and a large budget and 5 committees. Now I was working on my own, ferreting out value, picking securities, and just loving it, even though it was not organizationally important. I think that the recognition of the new meaning came around the mid-'80s, the 85, 86 period, because, when I started in high-yield bonds, the universe consisted, as I recall, of about $2 billion of securities, which is really tiny. Today, it's about $1 trillion. It was an insignificant back alley of the investment world. But in the mid-'80s, the private equity industry really came into its own. The private equity funds began to borrow huge amounts of money to buy billion-dollar iconic U.S. companies like Macy's and Federated Department Stores and U.S. Gypsum and National Gypsum and even Nabisco, RJR Nabisco. That's when about 30 to 40 billion a year were being issued. That's when high yield bonds became financially significant in the U.S. economy. That's when it became obvious that my phone call in 1978 had given me in 85 a seat on the front row of financial developments.
It's such a fantastic story. There's so many books that young people can go back today and try and at least give themselves a basic understanding. But I just find some of the early writings from the 80s, the early 90s that really describe the world that you were living in firsthand, such an amazing entrepreneurial account. I mean, so many names across so many industries raising their capital via high yield bonds. Just some fantastic stories. So motivating.
If I can just add, it really was a sea change. Mike Milken, I think, describes it as the democratization of finance. You have a delineation, a point in time. Before that point in time, only good companies could borrow money. After that point in time, any company could borrow money if it paid enough interest to compensate for the risk. And that's a massive change. And that latter attitude made its way through to all aspects of our financial system over the last 40 years, sometimes for the better. You can point to a lot of startups that were financed in part with high yield bonds, or not startups, but young companies that grew into a lot. And you can point to mistakes that occurred, massive mistakes, like arguably the subprime mortgage movement grew out of that sentiment as well.
Let me shift you, because we could talk about your early days for a long time and bring it up to current would probably be where you really want to be right now, because that's the focus of our conversation. And get into the conversation about cycles. I want you to define, from your perspective, a cycle. It's quite interesting. I have to say, going through your book, I was expecting something else. I was expecting a version of cycles that perhaps you might see on CNBC, where somebody says this precise movement means this will happen. It's quite different the way you explain it. I would love for you to define it. And also, if you could add, how far back have you gone to look at cycles?
First of all, there are cycles in science and in phenomena such as radio waves and sine waves and that kind of thing, which are precise, which have a consistent duration and amplitude and speed and so forth. And then there are financials in the world in which, and then there are cycles in the world inhabited by people. And because people are not so regular, the cycles they produce are not so regular. The economic cycle, the corporate cycle, the market cycle, and many others, these things are not as regular as sine waves and radio waves. Richard Feynman, the noted physicist, says that physics would be much harder if electrons had feelings. The point is that cycles in the financial world are produced by people, and they stem largely from the oscillations in people's feelings, which, of course, are not regular. A cycle is an up and down pattern around a midpoint, or it can be likened to the swing of a pendulum back and forth from a midpoint. The point is that the cycle represents a fluctuation in something where the norm might be described as that midpoint. It might be the PE ratio of stocks or the long-term trend in the value of the stock market. But the point is, these things don't move in a straight line. They fluctuate around that midpoint, and that fluctuation produces the cycle. Now, I've read about cycles going back hundreds of years. You have to read about history. First of all, you have to know history to understand the world. We don't have the advantage of living through history anymore. Of course, I've lived through 50 years of financial history, but I think you have to go back a few hundred years to understand the swing of cycles.
The thing that I really like about your perspective and how you explain cycles, which kind of got me to come into it, your thinking, it's not just that one is following the other. It's that each is causing the next. And I would love for you to kind of perhaps connect the dots. We have the dot-com crisis, and in a few short years, we have the subprime crisis. These are part of a cycle, and you can argue that they are connected and one caused the other. Is that a fair assessment?
I think the causality is better seen within each cycle rather than in the tendency of one cycle to cause the next cycle. I don't think too much about the dot-com bubble and crash was causal to the subprime bubble and crash. I guess the main connection between the two is that the pressed lows of the dot-com crash eventually gave way to, and in a modest way, the recovery from that crash, you could say, caused the subprime bubble. But I think the causality factor is better understood within each individual cycle than in terms of leading from one cycle to the next. But I think the important thing, and I think one of the key themes that I tried to get across in the book comes from a thought which is attributed to Mark Twain, who is said to have said that history does not repeat itself, but it does rhyme. What we do see from cycle to cycle is that the details, the height of the fluctuations, the violence of the fluctuations, the speed of the fluctuations, the duration of the overall cycle, etc., these details do not repeat. They're always different. And so people say, well, it's gone on for 2 years. Doesn't that mean it has to stop because it stopped after 2 years last time? These things are not important. The other thing that does not repeat exactly is the particular reason for a fluctuation or the effects of the fluctuation. These things also vary from cycle to cycle. But what does rhyme is the applicability of certain themes from cycle to cycle. So I think one of the most important points of the book is that when I look back over the hundreds of years, as I mentioned, of history that I've read about and the 50 years that I've lived through, what rhymes are the themes that underlying just about every financial boom, every market boom, are a few things like too much optimism, too little risk aversion, and too much money chasing a home. And if you take those three themes, I think you find that they do rhyme from cycle to cycle.
Why don't you connect the dots to the behavioral thinking? Because ultimately, if we think about cycles, and I think as you explained that citing Mark Twain, things will rhyme, but they're never going to be the same. I mean, it's kind of like us people. We don't take the exact same action each time, but over optimism, over pessimism, these types of things, our human behaviors are very consistent over a long period of time. And you, and I've seen many of your writings, many of your newsletters, you really take that great historical perspective where, I mean, somebody's reading Howard Marks, they're not walking away thinking, oh, I've got the latest and greatest short-term play. That's not the point.
If that's what people conclude, then I'm really happy with that. This is not a get-rich-quick scheme. This is hopefully a way through diligence that people can understand the investment environment. But you're right, it is key is the fluctuation of psychology. This is going to be consistent from cycle to cycle because people are, let's say, consistent in their inconsistency. Here's something to think about. If the stock market appreciates returns about 10% a year, which it does on average, over now it's been about 70, 80, almost 90 years that the data shows the stock market returns 10% a year on average. Why doesn't it just return 10% every year? Why sometimes 20 and sometimes 0 and sometimes 30 and sometimes minus 10? In fact, if you look at the history, are very few years in which the return on the S&P 500 is between 8 and 12. So if 10 is the average, wouldn't you think that the observations would be clustered around that average and that there would be a lot of years in which the return on the market is between 8 and 12? And in fact, it rarely happens. In other words, in most years, the return is either considerably higher than the average or considerably lower than the average, but it consistently departs from the norm. Why is that? And further, let me add one point. If you look at a company, its value, let's say you look at a company today, its value in 2030 or 2040 does not fluctuate very much. Reports a bad quarter, that doesn't change the terminal value. You know, it's going to be worth in 2030 or 2040 what it's going to be worth. And that doesn't change much as day-to-day developments change. And yet the price of that stock changes radically. Why? Human psychology. The point is that when the economy is doing well, when the news reports are good, when the company developments are positive, people get excited, the stock rises, the stock increase inflames them more, they buy it more aggressively, they get still more excited. There's this tendency for people to feel better about a company the higher its stock price goes. And of course, the converse, to feel worse about a company the lower the stock price goes. Now, Warren Buffett, who nails a lot of this stuff, says, I like hamburgers, and when hamburgers go on sale, I eat more hamburgers. And we all know that people tend to crowd the stores and buy more stuff during sales. And that's true every place except, well, I shouldn't say every place, but that's generally true, but not in the stock market or the investment markets. Because think of it this way, and I've thought about this a lot. See if you think this is true. You buy a stock at 60. It goes to 80. And you say, I think I'm right. I'm going to buy some more. It goes to 100. You say, I'm sure I've got this nailed. I'm going to double up. So you buy more as the price rises. But if you buy stock at 60 and it goes to 40, people say, I don't know. I better lighten up. My thesis may be wrong. And it gets to 20, they say, I better dump before it goes to 0. In the market, when things go on sale, people like them less. I think this is a universality, and I think this is a consistent theme over time. I'm oversimplifying, but I think that this kind of thinking accounts for a lot of the cyclicality in the market.
That fear of missing out. People don't want to be on the sidelines if their neighbors are doing so well.
That's a very key point that you raise. I mentioned that if the stock rises, people buy more. But what about the people who didn't buy at all at 60 and they watch it go to 80 and they watch it go to 100? The fear of missing out is a tremendously powerful influence. I think jealousy is one of the most powerful human conditions. There was a guy named Charles Kindleberger who wrote a book about the history of panics and crashes and booms and so forth. He said something like, there is nothing so injurious to your well-being as watching a friend get rich. It just kills most people to see other people making money. So, you know, at 60, you either didn't know about a stock or you didn't think it was a great idea. And at 80, you say, okay, maybe the people who bought it have something. But at 100, you say, they have to be right. I'm a dope. Why didn't I buy it? I have to jump on board. I call that process capitulation. Ironically, in the reverse of the hamburger story, the higher prices go, the more jealous people are of the other people who made money from something, and the more likely they are to jump on board. Until at some point, everybody who possibly could buy has bought. That the day that the last person who possibly could buy buys, number one, the stock has hit the highest price it can because there are no potential buyers left. And number two, the scene is set not for a further increase, but for a decline. It's this process of psychology and opinion becoming more positive and less positive that causes the violent fluctuations of stock prices around the company's intrinsic value.
Howard, I must ask, going back in time, you've had some fine schooling, Wharton, University of Chicago, but as a young man, did you have these principles and thoughts laid out coming out of fine schooling, or was there a school of hard knocks before you had the ethos in place that you're describing to us now?
Well, that's a really good question. Everybody talks about books like, what I didn't learn at the Harvard Business School. The purpose of schooling is to lay a foundation of logic and basic truths and maybe of how the world should be. But then you get out in the world and you juxtapose how the world really is. And that juxtaposition, I think, is what is so instructive. So it's impossible, I think, for anybody to arrive at their first job, as I did in 68, with a fully formed investment philosophy or view of the world, or at least one which will last very long under real world circumstances. So I had two events that were very influential. The first, when I started work at Citibank for the summer in 68 or full-time in 69, the bank was an adherent to something called the Nifty 50 school, in which it bought the stocks of the 50 greatest and fastest growing companies in America in the belief that they were perfect companies, impregnable, nothing could go wrong, and impossible to price too high. And if you held those stocks 5 years from 68, the greatest companies in America, you lost 80, 90% of your money because it turned out that the price was just too high and it fell to earth. And then, as we discussed in 78, I got the call, which got me into the high yield bond business. And now I was making money steadily and safely in the worst companies in America. Again, the juxtaposition of those two facts led me to the conclusion that it's not what you buy, it's what you pay. And that successful investing does not come from buying good things, but from buying things well. And that's it. I can't say that a bolt of lightning came down from the sky, or that there was one day on which I realized these things, but it was like a creeping epiphany. Yeah, I mean, if you can't understand the difference between buying good things and buying things well, you really can't succeed in the investment business. The success comes from not only what you buy, but when you buy it and at what price and under what circumstances. That was the real world realization that put my career on the path it has been.
Let me keep you in this space of you pulling together your education post your formal education. I know, at least having gone through your newsletters, voracious reader. I mean, so if you're giving feedback and influence and insight to young people or older people, whoever listening, the reading can never stop, can it?
No, it really can't stop because, number one, you never know everything. I mean, it seems silly to say, but it's obvious that knowledge is cumulative, but you never know everything. If you want to max out, you have to keep learning. And the best way to learn as an adult is to read. You're not taking classes anymore. You're not benefiting from the wisdom of professors. You have to keep reading in order to kind of vacuum up the wisdom of others. You can keep challenging yourself and keep incorporating new insights into your thinking. When we read, we don't just acquire new facts, but hopefully we acquire new ways of thinking about things and we gain new insights. For example, you mentioned my memos a couple of times. In 2006, I wrote one called Risk, and I wrote down everything I knew about risk at the time. And I think that risk, along with cycles, is one of the most important considerations in the investment world. So as I say, I wrote a memo called Risk in '06. It was complete at the time. In 2014, I wrote one called Risk Revisited. I added everything I had learned in the subsequent 8 years, which I think was a lot. And then in 2015, I was preparing that memo for publication in a book on Oaktree's 20th anniversary. And I had some more insights, including something I read from Peter Bernstein, an investment sage who had passed away a few years earlier, but I came across a memo on his...
The Remarkable Story of Risk, his book, Against the Gods, right?
Yeah. Well, not his book, but he wrote a book in '07. He wrote a memo in '07, or a newsletter, called Can We Reduce Risk to a Number? We know one of the great differences of opinion in the investment world is whether risk can be quantified and thus used in formulas for calculations, or whether it is just a subjective judgment. I'm in the latter camp. I think risk can't be reduced to a number. But anyway, I came across this newsletter on my desk, and I incorporated a lot from that in a memo in 15, a Risk Revisited again. I think if I wanted to come back to it, today I'd have more to add because I've read more and lived through more. And it's only through acquiring new inputs, clearly, that we can keep evolving. We either read something and learn from it, or we read something and we try to integrate it into our pre-existing way of thinking, and that adds to it. So you have to keep going. And I think, as Charlie Munger, Warren Buffett's partner, makes clear, it's very helpful to read not just investment books, but history, and not just financial history, but world history, and also science and the arts and so forth. Reading voraciously and broadly is really, I think, the best way to keep learning.
So I don't take you too far off the path of our main part of our conversation today, cycles. I would like to bring up the example of 2008, the crisis, the decline, the recovery. And you make the point in your newest book that the lesson is not that, hey, we can have a big decline and expect a bounce back. But you make the point, and you quote Nassim Taleb, to think about alternate histories, because it did not have to unfold like it did unfold, which brings into the notion of probability. And so I think that's something that, we can get seduced to think, oh, okay, the dot-com crash, then it came back. Oh, okay, the subprime crash, then it came back. That's not really the lesson you want us to take away, is it?
Well, certainly not in the subprime crash. I think we had these subprime mortgage backed securities, which I describe as fallacious. There just was no substance to these things. They were enormously overestimated as to their value. And a lot of people and a lot of financial institutions invested in levered, structured securities built out of subprime mortgages, enormously overpaid. so many financial institutions put so much of their capital into these things, into the highly leveraged tranches of these things, that there could have been a real meltdown of the financial system. And there could have been a depression like we saw in the 30s. This was the worst financial event since the Depression, but it did not rival the Depression in terms of severity or duration or impact on the average American. But it could have. That's the point. And, you mentioned Taleb, and his book, Fooled by Randomness, I think, has a lot of important ideas, one of which is the idea of alternative histories, which are the other things, I describe it as the other things that reasonably probably could have happened but didn't. You look at history and you say, oh, well, that's what happened. History is indelible. It's reality. Well, you have to understand history. You have to understand that there could have been other histories. And the history that unfolded was not the only thing that could have unfolded. So you sit here in 2018, we just passed the 10th anniversary of the bankruptcy of Lehman Brothers, which precipitated the worst part of the subprime, what's called the global financial crisis. We say, well, okay, that was bad, but we came right back. The markets cratered in late 08 and early 09, but they came back so strongly in latter 09, and they have been so good ever since that the lesson is that we can't screw it up. You have to buy the dips. Anytime there's weakness, just jump right in because it's always going to come right back. I think, as I say in the book, that that's the wrong lesson. It happens that people like Geithner and Paulson and Bernanke did things that A, were very powerful, and B, worked. The next time around, it doesn't have to go as well. The next time around, I don't think the recovery is as dependable and immediate as this recovery makes it look. I think that because things did not have to go as well as they did in the recovery, I think the lesson for government is that they should keep things from going to such extremes. We used to have the expression about the Fed that when the party gets going too strongly, they take away the punch bowl. That is to say, they take actions to cool off the economy and the markets. And they can do that, and they have done it historically. And I think it's a good idea. So, for example, when the stock market is going too strong and displaying what Alan Greenspan described as irrational exuberance, it's possible for the government to raise the margin requirements. So rather than buy stocks on 50% down, you have to put 80% down. And that would cool off some of the speculative behavior. Now, exactly how you do that in a world dominated by derivatives is not clear. But I think the concept is important, and it comes from learning the proper lessons from the last crash and not the lesson that there's nothing to worry about.
Can I interject just kind of one curious question I have? Having watched many videos with you and now speaking with you, you're very pragmatic. You remind me of my CPA. So I want to know, were you, even as a young guy, 10, 12 years old, a teenager, did you always have this very pragmatic personality about you?
On the one hand, I was probably always logical. And I think it's easy for me to think about these things because I think about these things kind of as mathematical proofs or logical progressions. On the other hand, boys develop slower than girls in general, and I think that I was slow to become serious, if you will. I didn't apply the logic I might have had to serious matters. The other thing is that gaining experience, having some success, having the opportunity to think things through to conclusions which then seem to work is very encouraging of the kind of what you call practical approach to life and to investing. And so I think that's how this came about. With the experience I've had and the opportunity to see these ideas work in practice, I think has reinforced the process.
To take you back to a cycle question, I see that one of the favorite things that so many people, when they talk to you, they want to ask you where we are in the cycle. I've seen you say that we're in the 8th inning, but hey, this is not a baseball game and we can go extra innings. So I guess my question really becomes, with all of your writings out there, and you're a pretty extensive guy, a lot of, voluminous works, why do people continually come back and want you to give them the magic number? What's that drive? Because we can all go read Howard's stuff. We know what you say. We know how you go about thinking about the world and your process. But so many people seem to kind of ignore that and go for the kind of easy layup. Hey, Howard, tell me where we are. What's going to happen tomorrow?
That's what people want. People want solutions. Most people don't want to perform the kind of serious study and rumination that we've been talking about on this podcast. They don't want the process. They want the answer. Most people understand, ironically, most people understand intellectually that the higher the market is and the longer it's gone up and the more positivity it has risen on, the less potentially profitable and the more precarious it is, and vice versa. So most people understand that there's a cycle that takes place, that where the market is in its cycle determines its future potential, and they just want me to tell them, or you to tell them, where it stands in the cycle. We can make judgments, and I can share with them my judgment about the fact that the economic news has been good, the corporate news has been good, the market performance has been great. The strong market performance tends to suggest that there'll be more of the same and tends to encourage more aggressive behavior. And as a consequence, prices get high and maybe they become too high relative to the intrinsic value. And the non-buyers capitulate and the holders celebrate. That all these things eventually tend to take prices too high, from which they are, the word I use is precarious. Everybody knows that. They'd love somebody to tell them, is there another 6 months to go for potential profits, or is the market going to start on its decline tomorrow? And the answer is nobody can tell them that. We talked a long time ago in this podcast about the fact that cycles involving people in psychology are not regular. They're not dependable. They do not repeat in their particulars. Nobody can say that when the cycle has gone up X% or has gone up for X years, that it's going to turn down. This one has risen for about 10 years if you're in the credit market like I am, or 9.5 years if you're in the stock market. The low was reached in March of 2009 in the U.S. stock market. We know how long it's gone, but I have no idea what it's going to do tomorrow or next month or even next year. I talk about tendencies in the book. I know that from elevated prices, the tendency is more to go down than to go up. But knowing the tendency tells you nothing about what's going to happen tomorrow. So yes, you're right. In 2008, in the crisis, people started to say, what inning are we in? And what they meant was, how much longer is the pain going to go on? I gave them my opinion then. And then more recently, they've been saying, what inning are we in? Meaning, how much more juice is there in this orange? How much longer can the market go up? And I've been telling them for some little time that we're in the 8th inning. But about a year ago, I made the key realization that the analogy to innings is really dangerous, because we know that a regular baseball game is going to go 9 innings. They never go 8, and they never go 10, and they never go 7 or 12. Regular, non-tied baseball games go 9, unless there's rain. But in the markets and in things that do not operate according to rules and regulations, in things where humans with their psychology are involved, we never know how many innings there are going to be. People should not rely on the absolute advice. But I think it's reasonable to think that when the market has gone up for a long time and when the valuations are above average and when a lot of optimism is incorporated in asset prices, then the tendency is more likely to be negative than positive. That's the only conclusion we can draw, but certainly not where we absolutely are, and certainly not what's going to happen in the near future.
To take a line from your work, the study of cycles is really about how to position your portfolio for the possible outcomes that lie ahead. That's just not a sexy CNBC soundbite, is it?
No, it's not. The pop culture wants people who will tell others what to do. It's really interesting that most of the people who appear on TV or in the press and who tell people what they should be doing never present the scorecard. They never say, I think you should do X. And by the way, 30 out of my last 100 pieces of advice are correct, or 60, or whatever it might be. I see these people on TV and I kind of say to the screen, okay, how are you doing in your personal account? Are you making money? What are your returns? How dependable are your judgments? And of course, these things are not reported. When I was a kid, I once heard someone say that an economist is like a portfolio manager who never marks to market. That is to say, who never computes performance. I think a lot of the talking heads are the same.
I have one final question for you, Howard. If you're willing to share, are there, beyond, and I'm going to give you the title of your newest book here in a second, but are there any books right now that you are reading, anything that you've read recently in the last year, anything you might want to push my audience along to check out outside work beyond yours?
I have a couple of books in the works right now. On my night table. One is called Factfulness. And basically it says that people reach conclusions about what's going on in the world based on their impressions and based on the media. And the media tends to emphasize extremeness. You never see an article which says, well, things are normal. They usually say things are too hot or too cold or too strong or too weak. The authors of Factfulness show you that things are not as extreme as the media portray or as negative as most people think. And I think that's really important. And another example of something I'm reading is Thinking in Bets. The author is one of the most successful female poker players, professional female poker players, and also a PhD in decision sciences. She talks about how to improve our decision-making process by reducing our potential decisions to bets and how to think about placing those bets. So those are two examples. Neither of them is strictly an investment or economics book. They're both interesting, educational, and also fun.
I had the second author on this podcast 3 times, Annie Duke. She is great.
Yes. Anybody who wants to make better decisions can learn from both of those books.
Howard, your book coming very soon, Mastering the Market Cycle, Getting the Odds on Your Side. Thank you for taking me down. I ask questions usually for myself, and the audience likes to listen, but thank you for taking me down the educational journey. I could probably sit around and for hours upon hours and just find little things to ask and get you to ruminate on. But hey, you've got things to do, but I appreciate you taking some time today.
Well, thanks a lot, Mike, and I hope your readers like the book. I hope it helps.
Thank you, sir.
My pleasure.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.